For this session, we are to talk about your chapter 3 until chapter 7 of your conceptual framework. We start first with chapter 3. Chapter 3 is your financial statements and the reporting entity. So in this particular chapter, this chapter is new out of your conceptual framework. As we said before, we have your 2010 conceptual framework, and then it was subsequently changed into your 2018 conceptual framework. So what we discuss now is your 2018 conceptual framework, and chapter 3 is not included in your 2010 conceptual framework. This is a new chapter under your 2018 conceptual framework. So under chapter 3, we are to talk two items. That is your financial statement, and then we have your reporting entity. So first, we discuss what is a reporting entity. A reporting entity is an entity that is required or chooses to prepare financial statements. So later on, when we go to your IFRS 1, you will know what is a reporting entity which reports PFRS's financial statement. When we say that is an entity which reports PFRS financial statements, that entity adheres to the usage of your PFRS. So your FS or financial statement is prepared using PFRS standard. Okay, so a reporting entity is anyone that provides financial statements. Soon, when we go to your IFRS 1, we talk about your reporting entity as an entity which reports financial statements with the use of your PFRS. Okay? So any entity which provides for FS is considered as a reporting entity. What is a financial statement again? This provides for the assets, liabilities, equity, income, and expenses of an particular entity. So financial statements provides or reports for these different items. Now take note for your different items or financial statements. Uh, your financial statements provides under chapter 3 of your conceptual framework three types. Normally in your AA 100, what you know on your financial statements is only a single or a separate financial statement. So what you know before is a separate financial statement. So this is a loan financial statement provided by a reporting entity. However, under your conceptual framework provides for three types of financial statement. First, we have your consolidated financial statements. Your consolidated financial statements is presented if ever there is a parent and subsidiary relationship. Sir, what is a parent and subsidiary relationship? We have a parent and subsidiary relationship when we have a business combination. What is a business combination? There is a business combination when two or more businesses decides to combine and report into one entity. So we have here two business, but will be considered as one entity under your business combination. Now, your consolidated financial statements happens only when there is a parent and subsidiary relationship. There is parent if ever this particular company controls the other company, subsidiary if that is the company being controlled. So, sir, when do we say that the other company controls the other company? So, we have a parent which controls the other company if the ownership is more than 50%. Okay. So, how do we say ownership again? As to equity participation. So, if you have equity participation of more than 50% over the other company, we have a parent subsidiary relationship. Therefore, we have a business combination. So what happens here? This parent and subsidiary will present one financial statement. They will present one financial statement known as your consolidated financial statement. Take note, guys, that in a business combination, as we said a while back, we have here business one and business two. They will now combine and they will present one financial statement. What is that one financial statement? We call it your consolidated financial statement. So what is the relationship between business 1 and business 2? We have your parent and subsidiary relationship. Okay? Consolidated financial statement. Next, we have your unconsolidated. So under your unconsolidated financial statement, there is a parent and subsidiary relationship. However, it does not present one financial statement. Okay, so we already defined what is a parent-subsidiary relationship. That happens when there is a business combination, there is a control over one entity to another. So the parent controls the subsidiary. Now, take note, guys, when there is a consolidated financial statement, what is important is the parent and subsidiary relationship and one FS. However, in your unconsolidated, there is a parent and subsidiary relationship. However, we present separate FS, meaning we present FS of the parent, we present FS of the subsidiary because we do not combine their FS. Okay, so in consolidated, since there is a business combination, what do we have here? One FS na lang. We call it your consolidated financial statements. However, in unconsolidated, there is parent-subsidiary relationship, but we present separate FS. Your consolidated financial statements is governed under PFRS 10. That is your consolidated financial statements. Okay? PFRS 10 or your consolidated financial statement. How about your unconsolidated? Your unconsolidated is accounted under PAS 27, known as your separate financial statements. So what is the difference between consolidated and unconsolidated? In consolidated, there is parent subsidiary, they will present one FS. In unconsolidated, there is parent and subsidiary relationship, but they present separate FS. So the FS of the parent will be separated on the FS of the subsidiary. Are we clear? Finally, we have your combined financial statements. Combined financial statements is not provided under PFRSS, meaning there is no specific standard that provides for a combined financial statements. Here, we present one FS, meaning there is a consolidated FS. However, there's no parent-subsidiary relationship. Okay, look as to the differences. Consolidated, there is a parent-subsidiary relationship, present one FS. Unconsolidated, there is parent-subsidiary relationship, present separate FS. Combined, there is no parent-subsidiary relationship, present one FS. So take note, what is the main criteria that you first look into? Whether there is a parent-subsidiary relationship. When is there a parent-subsidiary relationship? If one entity controls another entity. When can we say there is a control? If there is a 50% ownership over one entity. What is that 50% ownership? Equity participation. If you have an equity participation over one entity, which is more than 50%, then we can say we have a control. Once you establish parent-subsidiary relationship, it would be easier for you to understand what type of FS is presented. So, if there is a parent-subsidiary relationship, one FS, consolidated. There is a parent-subsidiary relationship but presents separate FS, unconsolidated. No parent-subsidiary relationship, present one FS, that is still considered combined financial statements. Sir, what if there's no parent-subsidiary relationship? However, it presents separate FS, is still considered unconsolidated because you are presenting separate FS. So in short, if that is separate FS, okay, I'll erase this one. So again, if it's separate FS, it is considered unconsolidated. If it is conso FS, so you will present one FS again. you will either call that FS as consolidated financial statement or combined financial statement. When is it consolidated? If there is a parent subsidiary relationship. When is it combined? You present one FS for two or more entities. However, there's no parent subsidiary relationship. Okay? So take note for this different FS. So in chapter 3, this is a new chapter under your 2018 conceptual framework. We have here a reporting entity that is an entity which produces financial statements. That is, of course, in consonance with your PFRSs. Now, there are three financial statements that is presented under Chapter 3. We have your separate financial statements, or known as your unconsolidated. We have your consolidated FS and your combined financial statements. Okay? So based on your reporting entity, take note, we will have different types of financial statements, whether unconsolidated, consolidated, or combined. Next, we go with your chapter 4. Under chapter 4, it talks about your elements of financial statements. So when we talk about your elements of financial statements, these are your different items of financial statements. So these are the items that you can see out of your financial statements. So first, we have your item of an asset. So before, you have already discussed this one in your AE 100, you have defined the different elements. So the definition of your different elements is provided under your conceptual framework. So let's have a recap on the different definitions. So first, asset. Asset is a present economic resource controlled by the entity as a result of past event. So here, what are the important requisites again? It is an economic resource. Next, there is a presence of control, and it is a result of past event. So when we talk about your economic resource, it talks about your right over economic benefits. Your right over economic benefits. One important characteristic of your asset is the flow of your economic benefits. If there is no economic benefit, then we don't have any economic resource. Therefore, under your 2018 conceptual framework, what changed? In your 2010, it explicitly tells you that there must be a flow of economic benefits. Again, in 2010, what is provided is the flow of economic benefits. So it's a resource controlled, resulting from past events, and the flow of your economic benefits directs to the entity or expects to flow to the entity. That is under 2010. Now, in your 2018, what is the definition again? It is a present economic resource controlled by the entity as a result of past events. So the economic benefits and the resource controlled are combined into one term. What is the term used now? It is now your economic resource. Therefore, when we talk about economic resource, these are your different resources controlled by the entity which you have the right to have economic benefits. So the definition is shrink over into one particular term, that is your economic resource. Another particular characteristic of your asset is the presence of control. So when we say there is a presence of control, what you look into here is the control over the economic benefits. Control over the economic benefits. Take note, as a requisite of an asset, ownership is not important. What is important under our characteristics? We have the presence of control. So for example, if you lease an asset, meaning you are renting an asset, since you are renting that asset, who controls the asset? Is it the lessor or the lessee? Okay. So, nagrerenta ka ng isang asset. Para mas maintindihan ninyo, nagrerenta ka halimbawa ng boarding house. So yung boarding house, sinong nagko-control niyan? Or sinong gumagamit ng economic benefits niya? Ikaw ba na umuupa or yung nagpapaupa? Ang sagot, ikaw na umuupa. Therefore, even if you do not own that particular boarding house, since you control it, you consider it as an asset. Therefore, take note guys, ownership is not important. Kahit hindi mo pagmamay-ari yung asset na yon or yung boarding house na yon, pero since kinokontrol mo yung boarding house na yon, sa'yo yung asset na yon. Okay? You consider it as an asset. So, the element of control. Lastly, it must be from a past event. There must be a past event or an event which creates the asset. Without an event which creates an asset, of course, you cannot recognize an asset. That's important. You already know that one. Once there is a transaction or event, you look whether you can recognize an item or an element. So from this transaction or event, we call that your past event. It should create either of the five. You can create either asset, liability, equity, income, or expense, or together both asset, both liability or asset liability, or a combination of the different elements. You learn that one in your AE 100. So it results from a past event. So take note now in the definition of asset, what is provided now? Economic resource controlled by the entity as a result of past events. What are the three characteristics? Economic resource, control, and past event. And what is the term provided now? Economic resource. That is defined as the resource controlled by the entity in which we have the right over economic benefits. Next, we have now the definition of a liability. What is the definition of a liability? A liability is defined under your conceptual framework as a present obligation to transfer economic resource as a result of past events. Okay, so here we have your present obligation. Next, we have your transfer of economic resource, and then it is from past events. Of course, we already know what is a past event. There must be an event in the past which created that element. So first, we go to your characteristic of present obligation. Why do we say it is a present obligation? Because you must have a duty to comply with a particular transaction or event. Without that particular duty or without that particular obligation, it means you do not have any liability at all. So there must be a present obligation or there must be an obligation. Without an obligation, no liability. Next, we look as to the effect of that liability. There will be a transfer of economic resource. Why? How do we settle a liability normally? We settle your liability by transferring an economic resource. Normally, by removing an economic resource on our part, so we pay it through an asset. So if ever, if asset is considered an economic resource, if we transfer our economic resource, that affects your outflow of economic benefits. Now, it gives us the change on our conceptual framework. In our 2010 conceptual framework, it provides that there must be an outflow of economic benefits. Now, in 2018, it is now transfer of economic resource. So take note, there is a transfer of economic resource which affects now outflow of economic benefits. Okay, so in short, uh, the definition under 2010 again was shrink into the definition under 2018. Under 2018, what is important? Present obligation, transfer of economic resource, and we have your past events. Further, guys, under your conceptual framework, past events is known as your obligating event. What is this obligating event? That is the event which created the obligation. Your obligating event is either a legal obligation or a constructive obligation. Please do not mix this up with your knowledge on obligations and contracts. It's different. So under accounting, we have your legal obligation or constructive obligation. What is a legal obligation? A legal obligation is an obligation that arises from law, instruments, statutes, or different agreements. So normally, these are your obligations that you talk about as civil obligations. while your constructive obligation is an obligation created by your previous expectations or your past expectations. Let's have an example for you to understand what is a legal and constructive obligation. Let's say you hired an employee. So you have a contract of employment. So whatever is provided on that contract of employment is a legal obligation. Okay, so let's say you need to pay it at this particular wage or salary, blah, blah. Next, what is a constructive? Let's have an example. So let's say for the past years, you always give bonus every month. So although it is not included in the legal obligation or in the contract of employment, but since on your past transactions, you always have that particular obligation or you always pay them a particular bonus, which now creates a constructive obligation on your part. So based on your past transactions, take note, based on your past transactions, you have an obligation. Okay? So based on your past transactions, you create an obligation or an expectation of an obligation. So take note of the definition of a constructive. It is based on your expectation, based on the expectation of a continuing past behavior. What is your past behavior there? Your past behavior there is the payment of your bonus, although not included under your legal obligation, but since your past behavior, you continually give a bonus, then you create an expectation on a particular entity that you will pay that bonus. Okay, so liability. What are the essential characteristics? It is a present obligation. There is a transfer of economic resource, and there is a past event. What do we call the past event again? Obligating event. That is either a legal obligation or a constructive obligation. Next, we have your definition of equity. So how do we define your equity? Equity is still the same definition with your 2010. So no change in the definition. So it is still the residual interest. Why is it considered your residual interest? Because asset less liability will give you your equity. So that is the residual interest of your owners over the assets of the business after paying your liabilities. Residual interest is known as your equity after paying your liabilities. Next, we have the definition of an income. So what is an income? So an income is present if there is an increases in asset, decreases in liability, which results to both increase in equity, other than contributions of owners. Okay, so let's take a look at this definition. Income is the increases in asset, decreases in liability, which results to your increase in equity other than contributions in owners. In short, any increase in equity should be an income. So take note which items increases your equity again. We have two items. We have your contributed capital and your earned capital. So your equity comes from either contributed capital or earned capital. What is your contributed capital? These are your different contributions from owners. In short, these are your different investments and withdrawals. How about your earned capital? This is the earnings of the business. So your equity is composed of contributions plus earnings. Remember, in your AE 100, how do you compute for equity? That is equal to your investment less withdrawals plus income less expense. Investment plus withdrawals talks about your contributed capital, while income less expense talks about your earned capital. So take note, if there is an increase on the equity, that must be either from contributed or earned. So when can we say it is an income? If that comes from your earned. Okay? So take note, that increase on your equity must be other than contributions of owners. Why? Because increase in equity, if we look at it, that is either investment or income. So if ever it is not an investment, it means it is an income. Yun yung ibig sabihin ng definition ng other than contributions of owners. Okay, take note, it must result on your asset, increase in asset and increase in equity. So if ever you will make an entry, you debit an asset, you credit an equity. Okay, what is that equity account? That is an income account. Or you will decrease a liability and you recognize an income. So normally, you debit an asset and you recognize a revenue when there is a revenue earned. When there is a revenue earned. How about a debit to liability and increase in income? If there is an unearned revenue that is now earned. Okay? Diba normally, you debit liability and you credit income if there is a previous unearned income and now you earn it. Clear? While asset and equity, if ever you have an income and you earn it now. I hope we are clear as to your increase in asset and decrease in liability and the meaning of the phrase other than contributions of owners. How about an expense? An expense happens whenever there is a decrease in asset, increase in liability, which results to the decrease in equity other than withdrawals. Okay. If investment and income increases equity, what decreases equity? We have two items. We have your withdrawals and your expenses. So, ang ibig sabihin ng other than withdrawals, we have only two items that decreases equity, withdrawals and expense. So, dapat daw manggaling siya sa expense. So, in short, if there is a decrease in asset, so decrease in asset meaning you will credit an asset and you will debit an equity. So this happens whenever you recognize an expense. How about an increase in liability and a decrease in equity? This happens if ever you have an accrued expense. Okay? If ever you have an accrued expense. Take note of that. So gets ba yung definition ng income at saka expense? So take note guys. Remember when we talk about your recognition criteria, it must be relevant and faithfully represented. Later, we will discuss this again, your relevant and faithfully represented. But in your 2010, it must meet the definition. It must meet the definition. So you must know the definition of the items. So asset, what are the essential characteristics again? It must be an economic resource. Next, the presence of control. And lastly, it is from past events. Liability, what are the characteristics? We have your present obligation. Next, there must be a transfer of economic resource. And lastly, there must be a past event. When we talk about past event for liability, we call it your obligating event. Equity, there is no change on the definition, is still residual interest. Income and expense, you look at these effects. Effects, increase in asset, decrease in liability, which results to increase in equity, other than contributions. Expense, decrease in asset, decrease in liability, which results to decrease in equity. Take note, these contributions or withdrawals talks about your effects of your capital. So we have your contributed capital and your earned capital. Your contributed capital are from your contributions of owners, so investment less withdrawal. Your earned capitals will have your earnings of the business, that is income less expense. So among the four items that affects your equity, which items increases? Investment and income. Which items decreases? Withdrawal and expense. So between the two, when we talk about your combination of asset and equity, liabilities and equity, it must not pertain to investment. Asset and equity, liabilities and equity, it must not pertain to withdrawals. Okay, so please take note of the definitions of your elements of financial statements as provided under chapter 4 of your conceptual framework. We proceed now to chapter 5. Chapter 5 is your recognition and derecognition. So before in your AE 100, you already talked about what is a recognition and what is a derecognition. So let's discuss first what is a recognition. So when we talk about recognition, this is the process of capturing the particular item to the financial statements. This is the process of capturing a particular item to your financial statements. So what is our recognition criteria? We said under 2018 conceptual framework, so long as the item is relevant and faithfully represented, we have a we need to recognize this item. So when can we say that it is relevant? If ever it is there is an inflow of economic benefits or outflow of economic benefits, when is it considered faithfully represented? If it's free from error, it is neutral, and it is complete. Now, our main problem here in your relevance and faithful representation is the uncertainty. What is this uncertainty? The uncertainty of your economic benefits or the existence of a particular transaction. Further, our uncertainty as to its measurement. So if there is uncertainty, that's our problem as to recognition. But take note, so long as it is relevant and faithfully represented, we can recognize it. Also, under your 2010 conceptual framework, we said last meeting, what is our recognition criteria? It is probable. What do we talk about your probable? Future economic benefits, either inflow or outflow. Next, it is measurable. And lastly, it meets the definition. So take note, one important criteria so that we can say we can recognize it is that it meets the definition. For you to recognize an asset, dapat asset talaga siya. Yun yung ibig sabihin niya. Para ma-recognize mo din yung liability, ibig sabihin, pasok siya doon sa definition ng liability. Pagka hindi, edi bawal kang mag-recognize. Yun yung ibig sabihin ng ating recognition criteria. But as you can see, the probable and measurable was already placed under your relevant and faithfully represented. Probable, ang kabaliktaran niyan is uncertainty on economic benefits. Measurable, kabaliktaran na naman yan is yung uncertainty ng measurement. So when do we say we can recognize an item? If ever we capture the item to the financial statement. Okay? So in short, if ever we recognize an asset, liability, equity, income, or expense, then that's the time that we can say there is recognition. At the time you capture it on your books, you recognize it. When can we say we can recognize? If it is relevant and faithfully represented. But of course, it must meet the definition of the particular item. So if an item is presented in their FS, plus it meets the definition of this FS. Okay, there is one constraint on financial reporting. What is this constraint on financial reporting? This is your cost constraint. Remember, this one is already discussed in your AE 100. What do we mean by your cost constraint again? Cost constraint happens if the cost exceeded the benefits. So the cost must not exceed the benefits. Remember that. Okay? The cost must not exceed the benefits. Take note of that. So if ever we are to report or we are to recognize an item, the cost must not be greater than the benefit. So sometimes when we try to recognize items, we must also measure them, right? So if the measurement, it's just so hard to obtain the measurement of that particular item, and the cost of recognizing it is already greater than the benefit, then probably you should not recognize it. Okay? So one constraint in financial reporting, also applicable to your recognition, that is your cost constraint. Okay? When do we recognize? If ever we recognize an item to the financial statement. So when do we say it is an item again? If it meets the definition of an asset, liability, equity, income, and expense. Okay? So that is for your recognition criteria. Next, we talk about your derecognition. What is your derecognition? So the recognition happens if ever, guys, that you will already remove from the financial statements, remove from the FS a particular item. Okay, so normally, what is only presented in the FS, which items again remains in the FS? Those items presented in SFP or Statement of Financial Position. These are your assets, liabilities, and equity. Normally, the recognition pertains to the removal of your assets, liabilities, or equity on the FS. Okay, so when do we remove an asset? We remove an asset if there's no more control. So if you do not control the asset, you remove it already. For a liability, when do we remove a liability? If there is already no present obligation. In return, these items affects your equity. Remember that, a decrease in asset, of course, will decrease your equity. An increase in liability or decrease in liability, increase equity, increase in liability, decrease equity. Okay? So remember, these two items affects equity. So when then we say we remove the item from the FS, the asset is derecognized when the entity loses control over the asset. So no more control. Remember, what is important in a characteristic of an asset? Control is important. Ownership is not important. How about in an obligation? You must have a duty that is your present obligation. If you don't have a present obligation, it means it is already settled. So in short, when do we recognize again? If we remove the item from the asset. What do we remove? The items that remains over the time. Diba? We have two types of financial statement that you have discussed before. In your AE 100, statement of financial position or your balance sheet, and statement of financial performance or your income statement. Items of your income statement reports only over a particular time, while your statement of financial position is reported for your items which remains over the time being of the business. So in short, this remains and these are not closed. So what are those? Asset, liabilities, and equity. So when we talk about items that are derecognized, these are items of asset and liability. Asset, you derecognize it if there's no control. Liability, you derecognize it if there is no more present obligation. Okay? So again, recognition, if it meets the definition. The recognition, you remove it. So if recognition is you include it in an FS, the recognition is removal of the item over the FS. Okay? Recognition and the recognition. Take note of this. What changed over the time for recognition and the recognition? Only the recognition criteria. Because in 2018, what is the recognition criteria? Relevant and faithfully represented. In 2010, what is the recognition criteria? Probable, measurable, and meet the definition. So the recognition criteria is now different under your new conceptual framework. Next, we talk about your measurement. So before, in your AE 100, you talk about your different types of measurements. So you have your historical cost, you have your fair value, you have your residual value, you have your market value, you have your current value. Those are the different things that you have discussed before in AE 100 as to your measurement basis. Now, under conceptual framework, the conceptual framework also provides for different measurement bases. And what are those? Historical cost measurement basis, and we have your current value measurement basis. Okay, So we discussed first historical cost basis. Historical cost basis is provided based on the price or the current cost of the transaction at the time the transaction happened. So this is the price of the transaction. So for example, you purchase a property, plant, and equipment. Let's say you purchase land na lang for 500,000 pesos. 500,000 is the historical cost. So whatever is the price of the transaction, that is the historical cost. How about a current value basis? Under the conceptual framework, it provides us three current value bases. So these are first your fair value. Next, we have your value in use. Next, we have your current cost. So your fair value, this is provided under your PFRS 13. The same definition under PFRS 13. This is the price for the asset or the price over the liability in an orderly transaction between market participants. Normally, guys, this is known as your fair market value. So this is the value that is fixed between market participants. So normally, to sell an asset or to pay out of that asset or to transfer a liability, fair value provided under PFRS 13. Take note, I told you the definition of your fair market value is the same with the definition provided in your PFRS 13. Therefore, the fair value definition under your conceptual framework is the same with your PFRS 13. Next, we have your value in use. So your value in use normally has two terms. We use only value in use for your assets and fulfillment value for your liability. Okay? Value in use for your assets and fulfillment value for your liability. So this is the current expectation over your asset or liability over their life. So current expectation over the life of the asset or liability. Kaya nga siya tinatawag na value in use. Ano daw yung value niya habang ginagamit mo siya? So, let's say, yung land, gagamitin mo for 10 years. Ano yung value niya for 10 years? So, value in use. Fulfillment value naman, as time pass by, how much should you pay or settle that liability? Okay? So, these are your current expectations over the asset or the liability. Normally, value in use is the present value of cash flows. Value in use is the present value of cash flows over the life of the asset or liability. Okay? Fair market value. That happens if there is a transaction between market participants. So whatever is the price in that orderly transaction, that is the fair market value. Next, value in use or fulfillment value. This is your current expectation over the life of the asset or the liability, or also the entity-specific expectation over the cash flows. That's why value in use is computed as the present value of cash flows over the life of the asset or liability. Next item on your current value basis is your current cost. This is the current amount. This is the current amount for the asset, but normally this is an equivalent asset. And for a liability, that is your equivalent liability. Okay, let's differentiate a fair market value to your current cost. On your fair market value, what we have here is a similar asset or a liability. So whatever is the particular price that is set in the market between the market participants, that is your fair value. While in your current cost, this is the current amount only. However, this is on an equivalent asset or equivalent liability. Not so similar, but only equivalent. Okay, So under your measurement, take note, we have two cost bases. What are those? Historical cost basis and current value basis. What is a historical cost basis? This is the price paid in our transaction. So let's say if you paid 500,000 for the land, the historical cost is 500,000. And in your current value basis, we have three items: fair value, value in use, and current cost. In your fair value, this is defined also under your PFRS 13. This is the price that is paid in an orderly transaction between market participants. And then we have your value in use. This is the present value of cash flows over the life of the asset, or the current expectation over the life of the asset. This value in use can either be value in use for assets or fulfillment value for liability. Also have your current cost. This is the current amount based on your equivalent asset or equivalent liability. So take note, fair value is on the particular asset or liability itself. Current cost is on the equivalent asset or equivalent liability. Okay? So conceptual framework only provides for measurement bases. These measurement bases are not actually all used in our items. What we normally use only is fair value and value in use. Current cost, we don't already use that item. Only if we cannot estimate the fair value, might as well use the current cost. Okay? So when we go to PFRS 13 or fair value measurement, you will learn these items. So initially, we measure it as historical cost. Subsequently, fair value or fulfillment, fair value, value in use, and current cost. Okay? Next, we go to chapter 7. We have your presentation and disclosure. So under presentation and disclosure, we have here your presentation over your financial statements and your disclosure over your financial statements. Okay, so where do we present? Normally, we present in your financial statements, and we already discussed your financial statements. Actually, chapter 7, presentation and disclosure, is a new chapter in your conceptual framework. This is not present in your 2010 financial statements. So when we talk about presentation, we talk about your presentation of items for your different items of financial statement. Okay, so we already have your different items of financial statement, right? We have your assets, liabilities, equity, income, and expense. So first, we need to recognize these items. So I've discussed already the items of financial statements, right? Under chapter 4. Okay. So that is under chapter 4. Under chapter 5, it provides you when to recognize them. So when we talk about recognition, we place them in your financial statements. But in recognition, you must also measure them. So we already talked about the measurement of these items under chapter 6. After recognizing and measuring it, then we can already present it in the financial statements. So that is under chapter 7. Now, under chapter 7, we must talk about your different financial statements. Take note, asset, liabilities, and equity is presented under statement of financial position. Okay? Or known as your balance sheet. Income and expenses talks about is presented under your statement of financial performance, also known as your income statement. Further, we also have your statement of cash flows. This is under past 7. We have your statement of changes in equity. We have your statement of comprehensive income. We also have your notes to financial statement. Okay. So normally when we talk about your presentation, this talks about your financial statements. When we talk about your disclosure, this talks about your notes to financial statement. So what again is the relationship between these items as to your items of FS and then to your different financial statements? Okay, so we have here assets, liabilities, and equity. We said it is presented under your statement of financial position. Income and expenses are presented under your statement or income statement, or also known as your statement of comprehensive income. Later, we will differentiate income statement and statement of comprehensive income. Further, the differences or inflows or outflows of cash due to these items are presented in statement of cash flows. They are presented in your statement of cash flows. Next, we talk about your statement of changes in equity. These items on your equity and your items of income and expenses goes to your statement of changes in equity. Take note, when we talk about equity, what are the items? Equity is equal to your investments less any withdrawals, plus any income, less any expense. So together with your income or expense, we create your statement of changes in equity. Okay. And then we also have your notes to financial statements. These notes to financial statements provides guidance over your SFP, income statement, statement of comprehensive income, statement of changes in equity, and statement of cash flows. That's why, if ever you still remember, when you prepare financial statements, you first prepare income statement or statement of comprehensive income. Next, you prepare statement of changes equity because this is needed to compute the balance of our equity. And then you can now prepare your statement of financial position or your balance sheet. And then we can now create your statement of cash flows. And then lastly, your notes to financial statement. Notes helps the different financial statements. And if there is a change on your standards soon under PAS 1, you will learn that we will create a comparative financial statements based on the changes on your accounting policy. Okay? So here in your presentation and disclosure, I told you what is the relationship between the different chapters. For chapter 3, we first discuss the different elements. And then in chapter 4, it provides you when to recognize these elements. And then chapter 5, you are now ready to measure. I know. Chapter 4 elements, chapter 5 you recognize, chapter 6 you measure, and then after recognition and measurement, you are now ready to present your financial statements under presentation and disclosure. When we talk about financial statements, what are the three types of financial statements under conceptual framework? We have conso, unconso, and combined financial statements. So those are the relationships in between the different chapters that we have already discussed. So take note on your presentation and disclosure. What is important here is how do you present the items or the elements and where do you present it? So again, asset, liabilities, and equity is presented under statement of financial position, while your income and expense is presented either in your income statement or statement of comprehensive income. Now we go to these two items. Ito lang naman normally yung nakakalito. What items are presented under your income statement and what items are presented in your statement of comprehensive income? Income statement is really income less expense. While your statement of comprehensive income, we have your profit or loss plus or minus your other comprehensive income. So we need to know the items of other comprehensive income. So what are the items of other comprehensive income again? First, you have your revaluation surplus. Next, we have your investments measured under fair value through other comprehensive income. Next, we have your translation gains or losses as to our foreign financial statements. Next, we have your items of employee benefits, particularly to its actuarial gains or losses. Lastly, we have your derivatives measured as cash flow hedge. So what is our mnemonics here? RITED, righted, or if you want S here, it can be cited. Okay, righted or cited. So again, what's the difference between income statement and statement of comprehensive income? In your income statement, you have your income or expense to get for your profit or loss. And then for your statement of comprehensive income, this is your profit or loss plus or minus your other comprehensive income. So the main difference is the other comprehensive income. So we need to know what are the items of other comprehensive income. First, we have your revaluation surplus. Next, we have your investments measured under fair value through other comprehensive income. Next, we have your translations, gains, or losses under your foreign financial statements. Next, we have your employee benefits on its actuarial gain or losses. Lastly, we have your derivatives used as a cash flow hedge. Okay, so these items are the differentiation between your SCI and income statement. Normally, what we prepare is SCI na lang instead of income statement. Ayaw na ni Pass 1 na mag-prepare ka ng IS tapos SCI. Isa na lang. Ang tawag ay is Statement of Comprehensive Income. Because here, as you can see, ang difference lang naman talaga nila ay OCI. Okay. Now, we have here your concept of recycling. So what is this concept of recycling? So when we say concept of recycling, sometimes items of OCI are recycled in your profit or loss. Sir, where do we present ba OCI? OCI is an item of your equity. So as an item of equity, normally, if it's already realized, we place it in your income or loss. That is your income or expenses. However, before, recycling is okay. Recycling before before recycling is okay or it is permitted, but now recycling is not permitted. What is recycling again? We transfer the items of OCI in the profit or loss. So under the amendments, your OCI items cannot be recycled. So soon when you have your translated gains or losses or investments in FVT OCI and they are already realized, we do not recycle them. What do we do then? If there is no more recycling, what is recycling again? Transferring of OCI to profit or loss. Since there is no recycling, what do? We transfer directly to retained earnings. We transfer it directly to retained earnings or to equity. We transfer it directly to retained earnings or to equity. Okay? So again, we have your different elements. What do? We recognize it first. And then we measure it. And then we place it on your FS. What are the different financial statements? I hope you have already read that under your past one. So we have your SCI, Statement of Changes in Equity, SFP, SCF, and your notes. We will talk about your SCF under past 7, Statement of Cash Flows. Notes is a supporting disclosure over your different financial statements. And if ever there is a change in accounting policy, you can have a comparative financial statements as early as the change you may permit to present your financial statements. Okay? So let's have a quick recap on the whole conceptual framework. First, on chapter 1, we talk about your objective of financial reporting, and that is the use of your financial statements. Chapter 2, we talk about your qualitative characteristics that makes your financial information or financial statements useful. Chapter 3, we talk about your different types of financial statements. Chapter 4, that is your different elements of financial statements, the 5 items. Chapter 5, that is your recognition and the recognition of your different elements. When do we recognize? If ever it is relevant and faithfully represented and it meets the definition of an item of financial statement. When do we derecognize? If we lose control and if ever we don't have a present obligation. Next, chapter 6, measurement. How do we measure? We have two cost bases under your conceptual framework: historical cost and current value measurement. And then after recognizing and measuring it, we can already present it. So that is your presentation and disclosure. I also told you as early as our introduction what we need to learn under conceptual framework and accounting standards are the recognition. When do we recognize an item? And then we need to measure it also. This talks about your initial and subsequent measurement, and how do we present and disclose the item. Okay, so since we are already done here in your conceptual framework, we will talk about your different items on recognition, measurement, and presentation disclosure as we go through your different items of financial statement, particularly a particular account, for example, inventories, PPE, investments, etc. So that's it for our conceptual framework.